My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Michael Kahn. A lot of different topics to talk about here, Mike, but for those who are not familiar with your background, introduce yourself. Who are you? How'd you get interested in markets? And what are you doing today?
How I got interested in markets is just dumb luck, but I'll spare the details. I've been a technical analyst for quite a while, got my CMT. I used to write a twice weekly column on technicals for Barron's, and now I'm at Lowry Research, which is a subsidiary of CFRA Research, and I'm writing about the markets using a different type of technicals, which really focuses on supply and demand rather than just all the other things that I think most technicians are familiar with.
I remember, I think you and I were interacting a while back, Mike, and I think you had mentioned that you had interacted with my father back in the day, maybe in the Merrill Lynch time. Just indulge me for a minute if I'm remembering that conversation correct. What was the extent of how you knew my father?
So thanks for outing me on
Right,
on the
exactly.
age thing.
Yeah.
But your father was a client of ours at a company called Trade Center, which was eventually bought by Knight Ridder Financial, which blah 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 as Wall Street goes went away. So he was a portfolio manager at Merrill Lynch, and he was using our Trade Center charting product, and that's how we interacted.
Yeah, okay, funny. Okay. I always like to talk to people that have some memory, obviously, of my father. It's been many, many years since he passed, but he's my dad, right? So it's kind of nice for me to hear those that somewhat remembered him. All right. So you started off at Merrill Lynch and you talk about technicals. Talk through to the audience how the field of technical analysis has changed or evolved since the days when you simply could not click a mouse button to put a moving average over a stock.
Well, I may be a lot older than you, but I'm not that old. I started out with computers. But the thing is, we didn't have a way to really interact with the world with our charts. It's whatever data was being fed to us, that's what we had. And the charts were pretty rudimentary, and you couldn't really do your own thing, make up your own formulas and things like that until maybe a trade station came along or things like that. But, things have changed just because data is available all the time, everywhere. So you take that into account, and how does that affect the technicals themselves? And the answer is, if technicals measure the urgency and the apathy of the crowd, and everybody can do everything all the time, and you have 1,000 ways to express a bullish or bearish opinion, meaning options, futures, ETFs, whatever that may be. So things are a little bit different. You take things with a grain of salt. As regulations changed over the years, like going to pennies on stocks from eighths, that affected some of the up-down indicator stuff and breadth reading. So you roll with the punches. You remember what we're after here. We're trying to assess the urgency to buy or the desire to sell, supply and demand, as we call it at Lowry's, and you take it from there.
Is it fair to say that technical analysis has become less art, more science over time, more quant driven as opposed to the interpretation of a chart like, decades ago?
There's a lot more quant, and I think the quantitative folks are really eating our lunch in terms of marketing and taking over the things that we really started with. You have to use both. You have to have rules. You have to understand what you're doing. You have to know that you shouldn't violate your own rules just to make a point or make a trade. But at the same time, you do have to understand that things are always changing.
Talk about some of the rules that you find are helpful when it comes to analyzing markets, and what are some of the things that people think are rules that probably don't mean very much?
That's a tough one because I don't put down rules on paper and then let them work. In other words, I'm still looking at the market and having rules in my head that I don't want to violate. It's really hard to vocalize what I'm getting at here. So I'm going to have to give you just this bad answer and move on.
That's a very good way to move on. Just telling me outright. Let's keep going. Okay, so if that's the case, all right. So let's then talk about, because yes, I agree. Obviously, when you're more discretionary, more technically driven, there are certain things related to market dynamics that you can't necessarily codify, right? Sometimes there is a gut feeling. Sometimes there is something that subconsciously makes you think things are going to play out a certain way, but it's hard to exactly know how to formulate that into a formal thesis.
I actually can give you an answer now. You can't let the what's going on in your opinions drive what rules you're going to follow. In other words, you can't just ignore certain evidence in favor of evidence that meets your preconceived notion of what's going on. So in that regard, you have to consider everything, and it could get complicated, but if you have basic rules that you follow, it shouldn't be too bad.
All right, so that's maybe a good transition to the current market environment. Because you mentioned that one of the key things that's different with what you're doing with Lowry is it's around supply and demand. I think most people would argue that technical analysis is entirely about supply and demand. First, let's go through what the Lowry method is and how you're thinking about the way the year has played out.
Well, I'll start by saying that, yeah, everybody's looking at supply and demand in certain ways. We stick to our knitting. We look at just a few things. We don't consider sentiment. I mean, tangentially, we know it's there, and we don't consider volume directly. We consider how the volume came in, up, down, up volume, down volume. So anyway, the Lowry, I guess, method is to look at a host of indicators and kind of like a trial lawyer, you get a preponderance of evidence to form your opinion from there. So we start with moving averages, and not just the averages themselves, but how many stocks are above and below their averages. We look at where stocks are with relation to their highs. So a lot of indicators we have are called percent above a moving average. And if it gets too far above a moving average, too high of a number, the market may be overheated. It's that kind of thing. I don't think that's going to be a surprise to anybody. And then we have some proprietary indicators, which are supposedly measuring how far stocks move, how much volume is behind them, and how many stocks are moving. So it's how many are moving in one direction versus how many move in the other direction. So we have these indicators called selling pressure and buying power, and they're kind of a secret sauce for us. But the point is that they help us assess the balance of supply and demand.
All right, so you mentioned volume, and it's not a very popular opinion, and I even put out that tweet a while ago that volume probably doesn't tell you as much as most people think. Do you think that the role of looking at volume has diminished over time because there's so many different ways that one can get exposure without necessarily volume on a stock chart?
Absolutely. I think volume is less valuable than it used to be. It's still valuable, but I think looking at it and just saying, okay, volume went this way when price went that way, it's probably not as effective as it used to be. And it's for the reasons you cite. There's so many ways to express a bullish or bearish opinion, and sometimes they're opposite. You're hedging a position and you're long one, short the other, and there's volume that has to be accounted for some way. So yeah, we don't look at the absolute level of volume so much. We look at how it's kind of broken down and up and down.
Okay, now if you were to look at moving averages here and sort of the basic technical analysis that often is referenced on FinTwit, probably everyone would agree we're probably still in a downtrend. Everything still looks pretty bearish, but you and I both know that there's always nuances to trends because there could be positive divergences that start to take place. I saw that myself in March of 2020 when yields, which were then pushing to all-time lows, started not pushing lower as equities pushed lower, suggesting that the fear trade back then was starting to abate. And you mentioned the percentage of stocks above or below the moving average. I'm sure you've seen this too. If you look at the NASDAQ number of stocks above the 200-day moving average, you have not broken the June lows, even though the NASDAQ broke the new lows, right, from June. Talk about some of the positives for a moment that you're seeing, if any, that might make you think that we are at some kind of maybe tradable long moment.
This is kind of a different concept. We look at kind of a capitulation and then return of strong demand or return of strong buying, and that takes a lot of forms. But the way we look at it is something that we call 90% downside days. Not a really unusual concept. People know that when 90% of the stocks are falling and 10% go up in a day, it's a pretty strong day of selling. But we marry that with the points, and the points just measures the amount that the stocks have gone down or up. So if we get a 90% volume down and 90% points down, we consider that a pretty heavy day of selling. And depending on where it comes in the trend and what their indicators are saying, we could say that supply is being exhausted there. What's interesting is that in September, we had a very long string of 80% downside days. And you could argue that 180% isn't a big deal. They happen more frequently than 90s. But to have so many in a row, I think it was a half a dozen in a row or within a very tight window, like 7 out of 10 days or something like that. So that's a lot of selling that's happening, a lot of urgency to sell. And then we end the quarter and start the new quarter with a near 90%, followed by a full 90% upside day. So you'd say, oh, well, we have supply exhausted and now demand is coming roaring back. That should be a bottom. And the key word is should. It wasn't supported by the rest of our indicators. So the positive is that supply seems to be on the road to exhaustion. But without the return of demand, broad demand, I mean, you'll know it when it happens. Without that return, we don't have a real bottom yet. So tradable, perhaps, but the real deal for our longer term investors, and I'll say that we don't think we're there yet.
Yeah, I mean, I would share that view. I've made that point many times that the bear market probably in stocks doesn't end until the bear market in housing ends, and that's still pretty early. But given the sentiment, and to your point, given the string of days and the path with which the losses have taken place, there is an argument to be made that you're probably going to have some kind of mean reversion, all in the context of conceivably still lower lows. Now, this path point, I want to hear your thoughts on, to me, has been what is one of the most underappreciated aspects of this year. I've put out these stats before. If you look at the number of weeks that the S&P 500 has lost money as a percentage of the year, right now in 2022, you're second only to 1931. In other words, you've had this unrelenting losses week after week after week this year in stocks, and then when it comes to treasuries, it's all-time highest as a percentage of the year going back to 1961. You've seen a lot of different cycles, Michael, and you know markets, you understand how these dynamics work. When you think about the way the markets have acted this year, what do you make of that consistency on the downside? Because everyone's been waiting for that capitulation. But I wonder if you can get capitulation just by kind of death by a thousand cuts, trying to play a long move, and then the odds just favor that you're not going to make money in it.
Well, that death by a thousand cuts could be just apathy finally building in, where people just stop caring and the market really just kind of sits there, bounces along the bottom for a while. So my assessment of the year is that it's just a downtrend. We hesitate to call things bear markets because it's kind of one of those things you can only see in hindsight. But at this point, it's a bear market. So we just stick with the trend on that one. There's really nothing fancy there. And, I keep saying to our clients, there's really nothing there that's changing our mind right now.
From a longer term perspective, secular perspective.
Right. Right.
Talk to me about some of the other macro asset classes that you're tracking. Any thoughts on commodities, how you think about currencies beyond stocks? Is there anything that you're observing that's worth paying attention to?
Okay, as a representative of Lowry, unfortunately, their answer is we don't follow that stuff directly. But as just a technician who you got to keep tabs on everything. The trend in the dollar is pretty remarkable right now. Is sentiment getting kind of overdone? It's possible. I mean, people are talking about magazine covers now, and I don't really buy that. But it's there and something to watch. In terms of bonds and interest rates, we just extrapolate the world from our own market here. With the curve changing, and it just doesn't appear like it's an environment conducive for our kind of investing. And what else we talked about? Commodities in general. Inflationary period, where to go for that, but not all of them are responding because some of them, like copper, are economically sensitive. So, from a Lowry perspective, all that stuff is kind of secondary.
About commodities, right? And okay, so it's not even, to your point, copper has gotten pretty smashed in this. Okay, but okay, so let's go back to supply and demand from the context of the Lowry method. You said there's not any sort of real signs of demand coming back in. What would typically be a catalyst for demand to come in, for confidence to take place? Because this is the kind of joke about momentum, right? For momentum to be a thing, you need to have momentum already be starting.
Not sure I'm clear on that one. What I would look for would be some of the indicators not making those lower lows. I mean, you mentioned something like that earlier. We would want like our proprietary stuff to start going up higher a little bit, to rise versus falling the way it's been doing. And we'd expect the percentages of stocks above these averages to start changing. So it's something obvious. When I lay it out, it's obvious to any technician who follows any of this stuff. So it's wait and see for us right now. We don't want to jump the gun, and we're just waiting for something interesting to happen.
So I think everybody's assuming that the thing that would be interesting to happen is a quote unquote Fed pivot, which everyone wants to talk about. I'm personally not of the opinion that the Fed needs to pivot for the markets to pivot, but because again, you've had plenty of rallies in the context of broader bear markets without the Fed changing its tune. But I am curious, Michael, from your perspective, if the behavior of the bond market you think might force something interesting to happen, either negatively or positively.
I don't really know about direct correlations or causations between the two markets. I think over the years, what I thought was the relationship has definitely changed. So I can't really give you a great answer on that. But, if interest rates continue to rise, and with or without the Fed, I think people are going to anticipate the Fed. So if they think the Fed is going to pivot, and the changes will happen before the actual change in Fed policy, it's a hard thing to follow, to predict markets based on the Fed, other than the don't fight the Fed thing that everyone's been taught. But it's a tough thing, I think, to nail us down, which is why we really stick to what we do, and that's just follow what's actually happening within the stock market. I'm kind of your worst guest here because I don't follow all these things that you do, and I'm pretty focused on just what is happening within the stock market.
No, but that's what I want to hear. I want to get sort of different takes on things. Let's get some of the audience up here for a question.
Well, as a technical analyst, I'm going to disagree with that. I think that all that stuff is baked into the market and how it performs. I also believe that these indicators work as the market goes up and as the market goes down. And at the same time, they work differently. A rising market is different than a falling market. I think there's a lot more emotion in a falling market. It happens a lot faster than a rising market. So a lot of these things are slightly different. There's an expression: the market rides an escalator up and an elevator down, meaning it falls a lot faster. I think the fear factor versus the greed factor is a little stronger. So if you're asking about support and resistance, I think that support at the June low in the U.S. market is a pretty powerful thing. And the bounce we saw last week failed to take it above there, at least meaningfully. So from that point of view, I think following the charts the way you're used to following them and using your indicators is still a valid thing. Just remembering that a bear market has a different emotional component to it.
How do you think about duration in a trend in these kind of periods, Michael? Because, from a relative strength perspective, and I shared to the Nest, your observation around utilities have been a remarkably consistent and strong outperformer, sort of the bond market proxy within the stock market, although a better bond market proxy than bonds this year. Do you do any kind of sector relative work? And if so, does that relative work help maybe frame the conditions that might favor a turn when, some sector is particularly long in the tooth in terms of that relative strength?
Absolutely. The sectors we follow, the Lowry sectors are equal weighted, so they don't quite line up with the S&P sectors that everyone's used to. But with that said, we found that over the last couple of weeks, utilities have just fallen apart in terms of demand. So they broke our index broke the June low. Demand has fallen off quite a bit, and its relative performance in demand has fallen off quite a bit. So that's one place that is no longer safe to hide, we think. And if you look at the alignment of the sectors, again, this is something that everyone knows. When tech and consumer cyclicals are healthy and leading the market, chances are the whole market is doing well. And when the staples and utilities and not this cycle, healthcare sometimes are leading, it's a kind of a defensive market, and things are probably not quite as good. So that's the alignment we see in sectors is just that negative configuration where tech is really on the bottom with the cyclicals. And that's how, one way that we could gauge a turn when some of these things start changing, and we could detect the changes in their demand trends hopefully before price starts to move.
Have you ever seen something quite like that with utilities where it's such a dramatic turnaround in relative strength? Because that's been a pretty remarkable weakness over the last, 10 trading days or so. I mean, utilities just totally got destroyed relative to large cap averages.
I don't know how far back in history I can go looking at that, but a lot of people just pile into utilities as a safety play when things are looking pretty bad. But they can't resist interest rates forever. I mean, the ones that have a strong dividend. they can't resist forever. So when bonds, are in their bear market, there's got to be a breaking point for utilities. I think we probably hit that.
Talk about new secular leaders, because I think a lot of people are of the mindset, and I tend to agree that if we're going to have another bull run, it's probably going to be driven more by the natural resource side of things, particularly energy. It's not going to be tech like it was in the prior cycle. Do you give any credence to that idea, and how do you think about sectors that have been sort of laggards for a while suddenly showing some strength?
I kind of think that a strong market's going to have your typical leaders in it. It's definitely a different world now than it was, even before I got started, where, tech is such a big part of everything we do in life. Even just the fact, I'm talking to how many people on my phone here without being plugged into the wall. I mean, these things they seem like not a big deal, but if you've been around, you can see that tech is everywhere. So I don't know if I'd believe that a resource driven rally could last that long. It just seems to me that the bottom of the economic pyramid, if you will, which is the basic materials and commodities and things like that. I mean, that's just the bottom, and the real progress in the economy is made at the top with tech and industrials, I guess, and things like that. So a resource-driven bull market, I don't know, resource-driven temporary rally, bear market rally might be something. I don't know if I'll go with a long-term rally driven with that.
Let me reset the room real quick for everybody's here for the remaining minutes. Make sure you follow Michael Kahn. He's been in business obviously a long time and very well versed when it comes to looking purely at the internals and technicals of the market. Certainly worth paying attention to his research. All right, so a lot of people, Mike, talk about the market in terms of the S&P. I'm glad you mentioned that with Lowry, you're doing more equal weighted type of analysis. But talk about how you view small caps versus large caps, because for me, this has been one of those things which is really remarkable. When you look at small IWM, for example, Russell 2000 divided by the S&P, the ratio of small to large has gone around trip back to the 2002 levels, meaning that if April 2002 you said I want to make a bet on more companies, smaller companies for recovery, you basically got the same return as multinational large caps with a lot more volatility. Do you think about different market cap tiers when you do analysis on different charts, and if so, what are your thoughts on the idea that maybe small caps end up overtaking large caps in terms of where the relative strength is?
Well, I don't know about overtaking, but we definitely break down a lot of our indicators into market cap size. So we'll look at a large cap advanced decline line, a mid cap, and a small cap advanced decline line, and do the same thing for what we call, well, everyone knows cumulative volume, and we do the same thing for our net points indicator. So we do break it down like that. As far as what's going to be, I don't know. We can't predict something like that. We'll get on board with the trends as they develop. And right now, if you're looking at price performance, the mid caps had a little awakening last month, but overall, they're really just market performers for, I don't know, maybe 2 years now, or a year or so, versus the S&P 500. The argument could still be made that they're in a downtrend from a couple of years ago, but I think right now, I think everything's moving kind of together, and I don't see an advantage to any of those cap sizes right now.
Yeah, and there's a lot of so-called zombie companies in there, and it's hard to sort of have any degree of sustained confidence. It's just amazing to me how the area which is supposed to have the most drift and momentum, because of the theory that they're less covered by analysts, so they're more inefficient, that's ended up being a real heartache from an alpha perspective.
Could be. I'm sorry, I can't be more well versed on that.
Yeah, no, for sure. Are there some stocks that you track personally that you think are also good tells on things? So Mark Faber of the Gloom, Boom, and Doom report used to always, for example, reference Sotheby's stock, right? Under the idea there that if Sotheby's is doing well, that's probably a sign of luxury spending and the consumer being fine. If Sotheby's is not doing well, that's kind of a tell on consumer spending dropping. Are there some individual stocks that you like to track that might be early signals or warning signs of what could happen to the broader market?
I used to track. I used to track what I called the four horsemen ETFs. It would be financials, housing, retail, and tech. I used to track them, and when they did something or headed somewhere, I was pretty confident in what the market was doing. That's changed. I don't really follow them anymore the whole idea of retail is kind of gone. There is not one type of stock or industry that would we would follow like that, just because we don't follow what's going on in the fundamental side of things. But we do look at stocks that are so heavily weighted, like an Apple and a Google and things like that. They're so heavily weighted that when they finally crack, the NASDAQ in particular is really going to have a hard time doing anything positive. So nothing specific industry wide, like following railroad cars or the power of FedEx or something like that, but just the stocks that mean a lot to the indexes. Well, following the Fed's been a cottage industry for forever. Looking at the size of the chairman's briefcase going into a meeting, or I think there was something about what kind of tie they wore. But I can't go with this coordinated attack on the market one way or the other. I think there's just too many ways information can spread now. I mean, maybe 20 years ago that could have been the case, but just look at Reddit or something like that, where information flows from individual to individual, right or wrong, or conspiracy theory or not. So I have a hard time thinking that there's this manipulated market move, manipulated behind the scenes in terms of what's the Fed doing and what their motive is, or politics or whatever. That I can't speak to. I think I forgot the second half of that question, but okay. Yeah, I could go with that. I don't think it was malicious, but when you're pumping money into the market, stocks love liquidity. So when they get it, they grow. When they don't get it, they fall back. So again, I don't think it's a conspiracy to manipulate the market. I think it was just an ill-advised method of dealing with the post financial crisis market when they just left it in place for way too long. So is it a bubble? Probably, but I just don't analyze that stuff directly.
But let's go with that a little bit, and again, let's factor in the sort of Lowry approach and supply and demand dynamics. Is there anything about those characteristics that you guys track today that looks like prior bursting of bubbles, whether it's the Great Financial Crisis, the 00 to '02 period, any parallels to other bubbles historically?
Well, if you look at some of the things that happen at major market tops that we've found, and the biggest of all are these divergences in breadth and other types of indicators. And the divergence we saw at the in January of this year, I mean, wasn't that bad. It was fairly mild. It wasn't that long. It wasn't like what happened in the 90s where you had the advanced decline line falling for a year or two. So it really wasn't that bad, and we didn't compare that to this pending bear market. I mean, we thought, get out of stock or lighten up for sure, but we didn't see a bear market, and I'm using air quotes on that. We didn't see that coming. But once it gets going, obviously indicators change. We change our tune. So comparisons to bubbles, I just don't see it. I just see a regular major pullback here. And we can relate it to the last question. Is it because the Fed is starting to pull in its horns, or the anticipation of that kind of action? That could possibly be it. Well, first, legend is generous, but thank you. And thank you for also reading down to the bottom of my LinkedIn profile to discover the windsurfing thing. In terms of earnings headwinds, it's not a Lowry thing. We don't follow what earnings are doing. We only follow market reactions to everything. So I can't give you a satisfying answer on that one either. Michael, I'm sorry. You got a pure technician here who doesn't really look at all of the other fun things that you look at.
No, it's funny. I don't look at that stuff either. I mean, I'm going back to the earlier part of the conversation. I'm entirely quant rules based in a very simplistic way. I mean, you're a CMT chartered market technician. The 2014 Dow Award, the 2016 Dow Award, those papers that won the Dow Award from the CMT Association, they're purely quant based, rules based with an academic method. Nothing to do with earnings, nothing to do with anything except market behavior. So, that's why I'm always a fan, Michael, of trying to focus on the things that have predictive power. That's why I start off the conversation asking you about things that matter, things that don't, right? So a lot of people will reference earnings and earnings revisions. It may not really have any predictive power. It may have some in the small sample, but over time, I have not seen anything that really suggests you can create a strategy around it. You can create exact buy and sell points, right? Whereas obviously when you're more technical and more quant driven, it's very specific. This indicator crosses, or this signal turns, that's when you execute a trade. So I think it's, being able to identify what works and what doesn't and how to translate it into actual buy and sell signals. I mean, that's the real power of what you're doing.
That's something I like to talk about, and when I make presentations in public, is that there's only three things that you can do, no matter how smart you think you are. I mean, there's only three things you can do. You could buy it, you could sell it, or you could do nothing, or hold it, or not hold it. So it all boils down to making a decision, which is why I think it's great to keep it clean and keep it rules-based and simple, and that's it. So the idea is not to look smart, because if everyone looks at all of our calls, we don't look so smart. There's plenty of mistakes. It's like, what do we do with them? And when we realize that perhaps a call was wrong, and when to change your mind. So it's really all about the decision making and what do you tell your client to do. Well, definitely I've seen an increase in volatility using our indicators, and I don't mean use the standard volatility indicators that measure it directly. There were maybe a handful of 80% and 90% up or down days in the second quarter, whereas in this quarter we're maybe more than 24 in the third quarter. That doesn't even include last week, which is the fourth quarter already. So the intense days of buying and intense days of selling are coming quite frequently now. So yes, volatility is there. The question is volatility a predictor of market trend? And I'll quote John Bollinger, who said that volatility can often precede a change in trend. Is that what's going on now? Perhaps, but definitely it's more volatile. It's harder to latch onto a trend and ride it comfortably, because with these big swings, getting stopped out isn't fun. We're actually, I wouldn't say having problems with, but finding anomalies with some of our proprietary stuff, just because we're getting a lot of signals that we have to interpret in light of the full body of evidence. So we could get some buy and sell signals that are supposed to be intermediate term, and we'll get 3 or 4 of them within a month. So obviously that doesn't work for portfolio management. So we have to really contextualize in the full body of evidence, which says, well, are we seeing a change in breadth? Are we seeing a change in volume on up days versus volume on down days? And because we haven't had that, all the buy signals we've gotten recently, we've kind of said, well, they're not really that good, even though they're there, and we believe that they happen. So we haven't really been following them, or should I say, emphasizing them. I don't want to say that the signals are no good. It's just in light of everything else that's going on. So is the stuff working? I think it is working. It's just we have to take it with a grain of salt and understand the market that we're in at the time.
I'm going to make that point about anomalies, because I've been on that kick for a while that this year is an anomaly from a multi-asset class intermarket perspective. Now I think people are starting to get it as they see the way the bond market's behaved, relative to equities in this bizarre correlation you haven't really seen in history. But let's talk about anomalies for a moment, because when you think about technical analysis, or any data set, right, you're always going to have an outlier which throws off for a moment in time your analysis, your conclusions. Do you factor in, from a sort of recency bias perspective, anomalies in some way, shape, or form, or do you treat them as just, somewhat random data points that you should ignore?
Well, it's hard to ignore hard data, but we do have to de-emphasize things that are just kind of out of the norm. We don't want to pick and choose data points that fit our narrative, but we have to be careful how we do that. I think to your original point, since 2008, the market hasn't been that free. It's been affected by events from outside the market, meaning the Fed and the government in terms of stimulus. Different times, different reasons. So to say that the market's different in the last 10 years, 12, whatever it is, 14 years, is not it's not an outrageous statement. It does feel different. The Fed is making an effect on what we do. I mean, our job as technicians is to roll with it and figure out how to cope with it. But yeah, I think a lot of the indicators have been affected. I'll start with the standard stock answer, which of course has no value, in that everything you've discussed supposedly shows up in price. So that's the theory of technical analysis. But to be more useful, technical analysis really assesses the crowd and how money is moving. Just because something is valued at a certain level, whether you do it yourself or some sell side analyst does it, the market is what people are willing to buy and sell, not what they think it's worth. So it's I'll give you a football quote. People are looking at the New York Giants saying that they're a terrible 4-1 team, the worst one ever, and we quote the old coach Bill Parcells, who says, "You are what your record says you are." So the value of any asset is what the market says it is. Now, your opinion can be different, and that's great. But what technical analysis tries to do is assess the trend of value and how buyers and sellers are acting. And a stock could have, I'll just pick a number out of the air. A stock could have a price of 80, but is it in an uptrend or a downtrend? And that makes all the difference in the world. Same price, but is the market trending higher or lower? And I think that's the real value in technical analysis, is assessing what the market as a whole, which is really where value is assessed or assigned, figure out what the market is doing and what it thinks.
How do timeframes factor into this, Michael, for you? Because there's a legitimate argument that everything just moves faster than ever before. That which might otherwise be a multi-year cycle may end up just being a couple of months in the extreme, like we saw with the COVID crash and recovery. How do you factor in different timeframes with your conclusions? Because I think true investors should have an ultra long time, in which case maybe technical analysis is not as important. If you're somebody that wants to be more active, that's where technicals come into play. But that also has the nuance of what time frame you're looking at.
I'll give you the official answer of yes and no. I think that technicals can help you in the long term. You can see long-term trends, and you could probably the fact that technology became more important in our lives years ago through the change in trends. It's unfortunate that it's always been associated with day traders and very short-term things, but portfolio management with technicals is definitely possible. First, relative performance of various groups or sectors or industries within the portfolio. You want to be overweighted the ones that are dull and underweighted the ones that are not doing so well. And technicals helps you figure that out with momentum indicators and with just comparing the two stocks, one to the other, and see which one. See if that the ratio of one stock to the other is going up or down. It tells you which one is outperforming. So if you use a longer term chart, a longer term scale on that comparison, then you should get a longer term assessment of which one is, quote, better to own.
Yeah, that's a fair point. Let's go to.
Well, we see the way we phrase it is months long deterioration beneath the surface, under the hood, and for us that means in breadth and in percentages near highs, and which stocks are doing better than others, and which sectors are doing better. So when you take all that and you look back and you see, okay, this is a bear market. What is happening to change that? And we don't see very much. So in that case, we have to stick with where we are, and that's being negative on the market. And how far down it's going to go, we don't know. We just want to be on the trend. We want to catch the meat of the trend. We're not quite that concerned with nailing the bottom. We just want to make sure that we get in as soon as possible when it does change. So in terms of the specifics on which stocks or how far or how fast, we just can't follow that. All we know is that at this time, it's not a good environment to be a stock investor.
So does that mean just sitting cash? What's the expression of that downtrend? Because a lot of people naturally say, well, that just means short it, but that's complicated for a lot of other reasons.
The shorting is not something we get into. Some of our clients may be that aggressive, but we're not going to go there. So it would be cash. Now, with that said, from a practical point of view, at some point, a stock like Apple is going to start saying, this valuation, I don't know what the valuation is. I don't follow that, but I'm saying that you could look at something that's fallen quite a bit and say, well, this stock isn't going to go away. And in a year from now, or 2 years from now, am I going to be happy? And I think that you can probably find a lot of stocks like that. We're not set up to find that. We're only set up to capture the meat of the major trend in the market and possibly sector rotation.
And if you were to put any kind of time frame to when you think this downtrend, gets exhausted, I mean, do you think about, are we talking just obviously follow the trend, but is there some exhaustion level where you say, okay, we're probably very long here on a secular trend to then suggest it's safe to get into the waters again? I'm trying to just address the point of how long it takes a bull market to return.
Well, there's another unsatisfying answer for me. We don't know. We can't figure out. We don't know how long something is going to last. All we do is stick with the trend and look for signs of change. And as of now, I'll say it again, we haven't found those signs. So is it going to go down through the end of the year? I just don't know. I don't know what would change it. I can't predict what the indicators are going to do in the future. We have to be focused on what is right now. And again, what is right now is that the weak market.
Very good. So listen, everybody, please make sure you follow Michael Kahn. Again, has been in the business for a while and has a great record when it comes to looking at markets. Is there anything, Michael, that you think people should be paying more attention to relative to what you hear from clients, what you see on Twitter, anything that you think people are not appreciating that they should put more of a spotlight on?
Well, it's the things that you shouldn't be paying attention to, and that's, stock tips on Twitter and Reddit and all those places. Use it to gain ideas, but I certainly wouldn't act on things I read without my own research. As far as things to look for, we're going to look for a slowing down in new lows, a slowing down in falling breadth indicators, things like that. So in terms of out of the market, I couldn't tell you. There's a million ways to interpret the Fed and a million ways to interpret any kind of regulations coming out of the government. So for our point of view, it's look at the price action and look beneath the hood at all those indicators that we follow. Sorry, I can't. I just can't give you that one good answer that everyone's looking for.
No, that's I mean, the reality is I always make this point. Anything that comes to when it comes to markets, for the most part, everything that people say is to some extent an opinion. And they say about opinions a pretty heavy one. So it's better to be honest and not have an answer that's definitive than not. I find it's just better to have more intellectual honesty and integrity that way. So again, everybody, please make sure you follow Michael. I'll have this as podcast soon enough. Thanks, Michael. Appreciate it.